Hello everyone, and welcome to this new video analysis where I will show you a specific option strategy on Henry Hub natural gas, because I think we have reached ideal conditions for such a strategy. However, before I start, I have to remind you that this video is not investment advice. And if I'm going to speak about specific financial instruments like futures, spreads, ETFs, or options, it's always just for educational purposes. Before I delve into the strategy itself, I should describe the overall situation in nat gas, in the Henry Hub natural gas. So I have prepared a few charts, or actually I have these charts in my watch list, and I'm watching them every week or even more often. So let's open them up, and I will start with a simple price chart for July 2022 contract, which is the current front contract. And I have to say that I'm bearish nat gas in the short term. While the nat gas has been in a strong uptrend since the beginning of this year, the price seems to be losing momentum because we have subsequent higher highs, of course, but the difference is the price differences between these highs are contracting, and also when you look at the chart, you can clearly see that the uptrend is starting to lose velocity, which is typical for a market that is losing momentum. So I expect that sooner or later the price will roll over and we will get a correction on this market. Now, I have to clarify a few things. This is obviously a counter-trend speculation because the nat gas market has been very strong. And although it is not a market that typically trends for a long time, like gold or some other commodities, I tend to say that nat gas behaves more like a VIX because there are these strong spikes higher, followed by subsequent crashes lower. It's the base level of the price that tends to move higher, and this is something we expected way before the current uptrend in energy prices. So if you are looking for a more longer term overview of the nat gas market or the energy market in general, I have to recommend you two older videos we made over the past few years. The first video is from March 2020. When we alerted you that things are about to change in nat gas, because now everyone is bullish nat gas and or energy in general, and everyone expects sky high prices. But back in 2020 in spring, it was very different. Everyone was bearish. People considered energy and especially nat gas uninvestable. The prices were Henry Hub prices were below $2, so the sentiment was very pessimistic. But we warned you that this will change, and the current decade will look very differently to the previous decade from 2010 to 2020. And we've been proven 100% right so far, because the market is behaving exactly as we predicted. There were some sharp spikes followed by a crash or two, but the point is the base level, the base price that was previously between $2 and $3 is moving higher. So if you want to get a longer term overview, I recommend you to watch this video from March 2020. And the next year, in 2021, in April, Yes, in April, we made another video where we told you how to trade NatGas in this environment, in this upcoming decade. So I also recommend you to watch this video because the strategy I will show you today fits this framework very well. Moreover, I will not talk about the long-term outlook today, so that's the reason I really recommend you to watch these two older videos so that you get a good overview of the general situation in the NatGas market. And now let's get back to charts. So I described the technical action or the price action, which might not be immediately bearish, but I think it creates the stage for the eventual breakdown and correction in the short term. Now I will switch to the commitments of traders' data, in other words, the sentiment, because I think the market is overbought in the short term, and I will switch from net positions to the net position index, which is better in this market, I think, and it's especially better when you want to analyze longer term history, which is exactly what I'm gonna do. And let's start with the hedgers. So I will zoom out for the last 5 or maybe even 20 years. And you can see that the COT index for the hedgers is deep in the negative territory. I would even say it's extremely negative and comparable to the previous extremes from 2017, 2014 or 2011. And you can notice that all of these instances marked the intermediate top on the NatGas. Now, I do not want to make any conclusions about the subsequent price action over these years, because as I told you in the video from 2020, from spring 2020, this decade will look really different compared to the previous decade. So I would avoid making predictions, predictions about the price behavior on NatGas between 2010 and 2020. I think this decade will look more like the decade before, between 2000 and 2010, when the base price was much higher and the price tend to spike into double digits. So that's a small detail to clarify about analyzing NatGas. So the point is, when I focus just on the bottom subchart on the COT index, that hedgers consider this market to be really overbought. They are hedging a lot at these price levels. So that is in line with the expectation of a short-term correction in the price of NatGas. And now let's switch to the large speculators, because the situation here is more difficult, because when some market is overbought, we expect a lot of speculative long positions. In other words, the speculative COT index tends to be rather high. When it, such as in 2019, you can see that it spiked to 0.60 or 70. So that was a typical situation of an overbought market, and that's not something we can observe right now. The speculative COT index is hovering around 0, which means that there is roughly the same amount of speculative long and short positions. So this is weird. And when you look back into history, you can see that the speculative COT index on Henry Hub NatGas worked not well. I would even say it worked really poorly in this market, because you can see that we can find similar instances in the past when the price was near the local top, but the speculative COT index was around 0, or even negative, as we can see in 2011 or in the first decade of this century, when it was negative during these large spikes in the price of nat gas. So it is probably not a great indicator in this case. However, I will show you a better way to measure the speculative sentiment in nat gas. Luckily, we have more COT data products in the SpreadCharts app other than the net positions or the positions index. So I will add a new subchart for the same underlying, but I will pick the net traders index. And I will show you the net traders index for the large speculators. And you can see that it looks really different compared to the net position index. I will not go into details explaining this data right now. I recommend you to watch the SpreadCharts tutorial. I mean, the tutorial to the SpreadCharts app. You can open it using this question mark icon where this is explained perfectly. I will just say that the market is not a democracy, which means that it works differently, because it is not that every human has a single vote. Instead, every dollar has a single vote, which means that a small number of market participants can control a large share of the market, and that is typically the case because there usually are a few large institutions that own the large part of the market, especially the large speculators. So that's what you see on the top subchart, middle subchart of the net positions, because this chart aggregates the positions themselves, the positioning data. The bottom subchart shows how it would look like if there was a democracy in the markets. In other words, it aggregates the traders based on their predominant positioning. So we can see that even though the net positions right now are around zero, the majority of the traders are net long, and I would even say extremely net long, because the current traders index around 0.6 is comparable to the previous extremes from 2018, 2014 and even before. So this is a stark difference to net positions or the position index, and I found, or I think this indicator for large speculators works much better in nat gas. But keep in mind, this is really specific to this particular market. So in some other commodities, it might be totally different. So I prefer to use net positions for the hedgers in nat gas, but the traders index for the large speculators in this particular market. So I will hide or close this middle subchart and show you just the price and the speculative traders index. And here we can see that it fits perfectly with the extreme sentiment and the peaks in this indicator fits perfectly with the peaks in price, either in 2014, 18 or even before in 2008. And even if I zoom in, you can see that it correctly predicted the local peak in October last year. Keep in mind, this indicator is not for a precise timing of the market. It's a medium-term indicator. But right now, it's it's definitely signaling overbought or even extremely overbought conditions. So that was the sentiment. Let's move on to the next chart, which is the seasonal outlook for nat gas. And I think this chart needs no explanation because you can see that the outlook is really bearish. The seasonal curves are falling between the middle of June till the end of July, especially the longer term curves. But even the 5-year curve is negative, is falling. So this is clearly bearish. And when you take a look at the bottom subchart, at the statistics based on, or statistics by month, you can see that both May and June are or have been historically negative for the price of nat gas, and July had been outright catastrophic for this market. So that's great for bearish strategies. And finally, let's take a look at the market structure, which is this study that basically compares the various bull spreads with the underlying. And in this particular situation, I tend to focus on this spread, which is the so-called Widowmaker spread. It's very important in the current situation because it discounts the market expectations for the next winter, because the nat gas market is usually above the expectations for the next winter, because traders or people in general tend to worry about the sufficient inventories of nat gas before the next winter, and that's exactly what this spread, which is the blue curve, is discounting really well. And if you look at the chart, you can see a clear divergence over here, because while the underlying, which in this case is the March 2023 contract, made higher highs, the spread failed to make a higher high here in May, and it is even starting to clearly diverge with the underlying, which is usually bearish. Of course, this is a short-term effect, and this is not something that works 100% of the time, because we can have a situation when the spread just catch up with the underlying and it moves sharply higher, so that is always possible. In other words, the longer the divergence goes, the more reliable it is. But I would recommend you to watch this chart very carefully, because right now it is the most important indicator in this situation. And it also has one advantage, because I told you that all these indicators like seasonality or even the commitments of traders are not really well for comparing the current situation with the last decade, because the current decade will look differently. And this indicator always delves or deals with the current data, so there is no bias from the historical data. But keep in mind, it's a short-term, very short-term indicator. So the price action, the sentiment, seasonality, and even the market structure confirms my bearish outlook for nat gas. And by the way, keep in mind that this is short-term outlook, because in the long term the outlook is clearly bearish. I won't delve into fundamentals here, because once again, the short-term situation is not as impacted by these long-term fundamentals. But it's fair to say that domestic US production finally got above 95 billion cubic feet per day, which is something we anticipated and considered to be necessary for any bearish or to think about any bearish strategy on this market. But demand is also higher year over year, especially the LNG exports. So the market from the fundamental perspective is rather balanced, and it will be the weather over the summer that will be decisive for this strategy. But right now the data looks bearish, and we shall see how the weather evolves over this summer in the US. Now, because I will create a short-term strategy, we definitely want to focus on the near end of the curve, because you can see that there are very sharp or large differences between individual expirations in nat gas, and this is pretty normal because these are different seasons, especially the heating seasons, and the current or the near contracts are incomparable to distant contracts, because the situation in the future might be totally different from now. But let's say that right now the near end of the curve is much higher compared to the long-term average term structure at this part of the year than the distant contract. So we want to exploit the short-term normalization in this gap between the current price of the short-term contracts and the longer-term averages. And I'm not predicting that the price will drop so low. I really don't have an idea. I just want to stress that the opportunity is on the near end of the curve, not here, not on the distant expiration. So that is critical, and we will assemble the strategy in this regard. But let's finally move to the strategy itself. I told you that the price of nat gas is losing momentum. The problem with these situations is that it can continue to lose momentum for longer than everyone anticipates. In other words, directly shorting the nat gas might not be the best idea. And that's the reason why I would probably go with option strategies, as the name of this video implies. While it would be totally fine to create the option strategy on futures if we focus on the near part of the curve, I would personally go with options on ETF, specifically the UNG ETF. And I'm very familiar with this ETF, because back in the days when I was managing institutional money, this was my favorite underlying for option strategies, and I was doing it in a sizable way, because I controlled the majority of open interest on the strikes where I placed my strategies or my bets, and it was working great. So I will show you how I personally would trade it in the current situation. So this is not a recommendation. I'm not recommending anything to anybody. I will just show you what I would do if I am still a portfolio manager. Although I'm bearish nat gas in the short term, the speculation on decline of the price of nat gas would be just one part of this strategy. There is another effect that I want to capture with my strategy, and that's the fall in the implied volatility, because currently the implied volatility on nat gas is elevated. When I take a look at the money options on UNG and do not go to leaps, to the distant expirations, and focus on near expirations, for example a month from now, the IV is around 80%. And I think, or my speculation would be, that this implied volatility would fall below 60%. The best case scenario would be decline even as low as 50%, because the range between 50 and 60% is generally the area where the implied volatility for these options spent most time over the past few years. So I would go with vertical credit spreads on the call side. In other words, I would sell a call option below the current price and buy another call option as a hedge above the current price. In other words, I want to stay with these spreads not too far from the current price. So these call spreads would be around at the money. And there are two reasons for this. The reasons why I do not go too much in the money, or on the other hand out of the money. And the reason is that I want to have enough of negative deltas to be able to capture the move lower in the underlying. And I also do not want to be too far away from the at the money options in order to profit from the decline of the implied volatility. Now, to be really specific, I would select 3 strikes, the 25, 30 and 35 strikes. The reason I focus on these round numbers is because the liquidity on them tends to be generally better than the liquidity on these minor strikes, especially once the price moves away from them. So I prefer to assemble the strategy from a few combination of spreads, then going with one spread on these minor strikes. So that's, by the way, the reason I would pick these strikes. So I would create 2 spreads. The first spread would be made of the call options on $35 and $30, and the second spread would be on $30 and $25, which means selling the $25 call option and buying $30 call option. And I would assemble these spreads in such a way that my break-even point would be close to the current price, or generally close to $30, because as I told you, I expect the price, or I do not expect, but it's well possible that the price can drift higher for some time before eventually rolling over. So I would not open one spread, but a combination of 2 spreads. One of them slightly below the current price, and the second one slightly above the current price. When I mean the midpoint of the spread. And I definitely want to get at least $1.50 from the spread, from the 5-point spread, in order for the deltas to be negative enough to profit from the eventual decline of the price of UNG. And this also brings me to the expiration I would pick for the strategy. With this short-term strategy, I would aim for the expiration between 1 and 2 months. Anything shorter than 1 month is too soon, because as I told you, the market might not lower immediately. It can take some time. So I want to have enough time for this movement to play out, which is the reason why I would go with the expirations above 1 month. On the other hand, I do not want to go above 2 months, because these options, these more distant options, are less sensitive to the movement of the underlying, and also to the decline of the implied volatility. So I think the expiration between 1 and 2 months, this is the sweet spot for me in the current situation. And if you look at the expirations on UNG, there are monthly expirations in July and October. I think the July expiration is fine. The October expiration is too distant, so I would avoid going with the October expiration. But there are also weekly expirations that might not be as liquid as the monthly expirations, but I wouldn't be concerned in this particular case, because the UNG is very liquid ETF, so even the weekly expirations are fine. And there is one weekly expiration after the July monthly expiration, so this is the one, together with the July monthly expiration, that I would consider for my vertical spreads. So we are talking about options that have 40 to 50 days to expiration. I also checked the prices of these options, but just briefly, and I think it is doable to get one-to-one risk reward on the vertical call spread between $25 and $30, which means that I think it's possible to get $2.50 from $2.50 of premium from this 5-point vertical spread, and it's also doable to get or possible to get $1.50 of premium from the higher call spread. I mean the call spread between $30 and $35. Like I said, $1.50 is the absolute minimum I want from these spreads. And it's obvious that the lower call spread has a better risk reward because the midpoint of this spread is below the current price. But I would combine these two call spreads to get a break even roughly around the current price or around $30, which I think is would be the best thing to go for me. And I would also definitely avoid going all in immediately. It's much better to scale in gradually into the market because, as I told you, the price may continue to drift higher for some time, and that would allow me to, reach a better overall break even with this strategy when I'm able to scale with subsequent purchases on higher prices. And if I'm wrong and the price rolls over immediately, then I would have a smaller position, but it would quickly turn into profit, which is never a bad thing. So that was a description of the strategy and the entry into the strategy. Speaking about the management of the strategy or of the vertical spreads, I would avoid holding them till expiration. That is never a good idea because of the gamma risk. So I would get rid of these spreads well before the expiration. And my goal would be to close part of the position when the implied volatility drops below 60%. And that is something that may occur even before the move lower in the underlying, because I would not be surprised for the price to move sideways or drift slightly lower, the implied volatility to decline, and then eventually the price to roll over. I mean, this is just a speculation. Maybe the price will, move sharply lower immediately, or maybe sharply higher. I don't know. I can be wrong. But once again, I would get rid of part of the position even if the price moves nowhere, but the implied volatility declines below 60%. And depending on the behavior of both the underlying and the implied volatility, I would roll over to the next expiration when the time to expiration of my position drops below 2 weeks, no matter what. No matter if the market goes against me or in favor of my positions. This is something that is really important. Not to hold the position too close to expiration. It's definitely better to roll into the more distant expirations, even if the market moves sideways. And of course, I would close the entire position if we get significant move higher in the underlying, in the price of net gas. So I think that is all for today. My goal was to describe the strategy in detail, which might not be really comprehensible for everyone, but I wanted to be really explicit because I think it provides a great deal of educational value when you can see what I would personally do in the current situation with this particular strategy. So I hope this video will be helpful to you. Thank you for watching us, and see you next time.